Good morning, everyone. This is Dinara Millington, the Vice President of the Canadian Energy Research Institute. I will be hosting this morning's webinar that's looking at whether Canadian oil and gas regulatory framework is competitive in comparison to other jurisdictions. I'm just looking at the list of attendees. I'm just going to give a couple more minutes for others to join us, and we will start shortly. Thank you very much. All right, we are ready to begin. And first and foremost, I must apologize for the way I sound. I'm just recovering from a cold, so I'm not auditioning for Old Spice commercial anytime soon, but hopefully bear with me for next hour. Um, for just the housekeeping remark, if this is your first time joining our webinar, there are options on your slide there how you can join us to hear me. Either the microphone or speakers that's built in using VoIP, or telephone that is down there on the slide for you for accessing the slides, and the audio with the access code provided below. All right. So for questions, please submit them as you see fit. If you have a question right in the middle of the presentation, just feel free to type it in the box there that you see in your dashboard. I will get to the questions afterwards, after we have completed the presentation. Also, a copy of this presentation is available to you. You can download it through handouts panel there, or you can request a copy after the webinar is complete. All right, jumping just before we start with our morning's webinar, just to, if you're not familiar with the Canadian Energy Research Institute, we have been around since 1975. This is our 45th anniversary this year. This research would not be available without generous support of our funders and our supporters, which include Department of Energy through Alberta Government, the Canadian Association of Petroleum Producers, and Natural Resources Canada. We also receive funding support from the University of Calgary, Canadian Energy Pipeline Association, Chemistry Industry Association of Canada, Alberta Industrial Heartland, the provincial governments of British Columbia and Saskatchewan, Ivy Foundation, and SM Blair Family Foundation. As I said, we have been established since 1975. We specialize in economic and environmental research that relates to Canadian energy systems, anything from energy production through midstream processing and transportation and final end-use consumption. Our mission is to provide relevant, independent, and objective research that would aid in decision-making for businesses, government, academia, and public at large. CERI produces 8 major studies per year, but in addition to that, we produce quarterly market-specific updates and geopolitics of energy. We also host an annual conference that's coming up in June that relates to petrochemicals. All right, so going through the agenda for this morning's webinar, what I will do is I will cover the study findings of a recent study that we have completed and will be published in the next couple of weeks on our website, looking at the competitiveness nature of the Canadian oil and gas regulations. I will go through some of the background and set the context to the study and why we decided to do that, go through the scope and methodology of our analysis, and then through the results of the findings. Why did we decide to do the study? Well, there are multiple regulatory competitiveness studies that have been done, but none that have looked at the full scale of economic and environmental regulations and determining the individual and cumulative costs of regulatory regime for the oil and gas sector in Canada. Our comparative jurisdiction is United States, and I will go through a little bit more detail of what jurisdictions we're going to cover. So what also has prompted the study, besides looking at the incomplete literature that is out there, are the sort of hurdles and challenges that have been identified by the oil and gas sector. First and foremost, as we're not surprised, is lack of restrictions of market access to traditional and international markets for Canadian commodities. There's increased volume of regulations and regulatory process inefficiencies, lengthy approval timelines, and increasing regulatory costs. Increasing number of taxes on oil and gas industry resulting from competitiveness impacts, and the overall changes that have happened, that have transpired over the last couple of years in the regulatory process. Specifically, what I'm referring to is the redesign of the National Energy Board to the Canadian Energy Regulator, as well as moving from the Canadian Environmental Assessment Agency to the new Impact Assessment Agency of Canada, as regulated by the new Bill C-69. There is still ongoing judicial and regulatory hurdles for major export pipelines from within Western Canada to reach export markets. These are Trans Mountain System, Keystone XL, the natural gas Coastal Gas Link, and the refurbishment of Line 3. There's also an evolving and uncertain Indigenous legal landscape as it pertains to the large industrial projects as we move forward with the new impact assessment strategy. So as I mentioned, the study does consider environmental and economic regulations for the oil and gas sector as they compare to the United States, with the purpose of identifying how the regulatory regime influences the competitiveness of Canada as an exporting jurisdiction. So when we first looked at the regulatory space, we understood that the space is very complex and we need to set some criteria and some parameters around this analysis. So first of all, what we're doing, as I mentioned, the regulatory framework that is in focus is looking at environmental regulations and economic regulations. We also did a high-level assessment of Indigenous and other social regulations as it pertains to oil and gas development. The cases that we have examined are here on your slide. We are looking at a typical onshore oil and gas well, an offshore gravity-based structure, an LNG facility, an interprovincial and or interstate pipeline. The jurisdictions that we considered in this particular study, as these 4 cases will fall under, are looking at the federal and provincial jurisdictions of Canada and the provinces of British Columbia, Alberta, Saskatchewan, and offshore Newfoundland, as well as the federal jurisdictions of United States, the Gulf of Mexico offshore, and the state level regulations in the states of Texas, North Dakota, and Pennsylvania. The major characteristics of the regulatory framework that may impact the competitiveness are identified here on your slide, and I'll just briefly go through them just to give you a context and background of how did we define these. Predictability, what we mean by that is consistency of the regulatory process with standard timelines, clear decision-making criteria, little or no jurisdictional overlap for regulatory approvals, and minimal process requirements ambiguity. On the transparency, by transparency, we mean availability, clarity, accuracy, and accessibility of the comprehensive and up-to-date information for all stakeholders. Stringency is the extent of the regulatory control, including but not limited to requirements, restrictions, and conditions associated with the regulatory approvals, as well as consequences and costs of non-compliance. Compliance is the existence of a framework and procedures for the monitoring and enforcement of limitations, commitments, and restrictions. Timelines is a time for rendering of a decision, approval or not, on a specific project. Cost is the amount of money spent either directly or indirectly on the regulatory process, plus any change in the value of the project due to the amount of time spent achieving a regulatory decision. And last but not least is regulatory improvements are the activities undertaken by the government and or regulatory agencies to increase predictability and timeliness, increase clarity regarding the transparency, stringency, or compliance expectations, or reduce the overall cost impact to the proponents and interveners. So there's as you can imagine, there's a whole large volume of literature available out there that pertains to regulations and guidelines and policies within the Canadian oil and gas sector. This slide presents a summary of the review of the literature that the CERI team has done, and we have selected the regulations that that will be pertaining to specific 4 cases that we are examining. As I mentioned, the scope of this regulations is definitely not all exhaustive. Only the key laws and regulations for each area are presented here. The NR, as you see on your slide here, refers to not reviewed. And this specifically pertains to a review of relevant guidelines and programs, and which are optional as they are not legally binding. So it rather shows examples of the existing additional policies on top of the acts, regulations, and codes that the project proponents must abide by. Some of the reviewed regulations are no longer existent. However, they do impact the study period for the study and therefore are included in this table. For Newfoundland offshore, the key regulations overlap with the federal ones, which include agreements between the federal and provincial governments relating to offshore petroleum resources, as there's a shared management of oil and gas resources in the offshore. The federal economic regulations for the United States include 4 guidelines specific to the onshore oil and gas activities, and another one specific for the offshore Gulf of Mexico. So part of the work that we have done when we reviewed the literature was also to do a survey assessment of various stakeholders that are impacted by the competitiveness of oil and gas regulations. So we have contacted 91 organizations in Canada and United States, of which about just over half are representative of the oil and gas companies, 30% are government and regulatory agencies, 9% were financial institutions, and 7% of the Indigenous organizations. We unfortunately we did not receive responses to a higher response rate as I was hoping for. The response rate averaged about 27% there, as you see on your slide. We did not get any responses from the financial institutions, unfortunately. And the 2 biggest buckets of the stakeholders that where we did receive a lot of input were the government regulatory agencies and industries. Of the Indigenous organizations that we contacted, we've only received responses from 3 different organizations and only within Canada. This is just a quick breakdown of the respondents and where they're coming from, by stakeholder group, by role in the organization, jurisdiction, and by case. As you can see the slides, within the number of respondents, the number was 23. The main stakeholder groups that showed the most interest within the stakeholder group industry was the most responsive. In the survey responses distribution by jurisdiction, where you see the other wedge there, it represents Nova Scotian LNG case. We only received one response, and hence we stuck it in there. Even though the response rate for this survey was not sufficient to create a representative sample for the whole industry, the responses provided, they drew a consistent feedback with a typical pattern, which is on my next slide here. Excuse me. Hurdles that impact the business success, with 5 being the most significant and 1 being the least significant, represent overall responses from all stakeholder groups and are summarized by the 4 different cases that we have examined. As you can see from the slide here, regulatory uncertainty and access to the demand market are the biggest concerns. They do have the highest ranking of all of the 3 out of 4 cases. The regulatory cost competitiveness has the 3rd overall ranking. It is of concern for offshore wells and pipelines, while for onshore wells and LNG, it was ranked lower. Carbon prices and policies has the 4th ranking overall, and the access to financial markets has the lowest overall ranking. It is ranked the least for LNG and pipeline projects, 2nd least for offshore wells, and moderate concern for onshore wells. This slide summarizes the overall opinions of the survey results with averages of all inputs from all cases for each group. This particular slide does not differentiate between federal and provincial responses. Representatives of the governments and regulatory agencies in both Canada and the United States agreed on the predictability of the regulatory regime, whereas it was cited as a real issue by the oil and gas industry and some Indigenous stakeholders. A disagreement between those stakeholder groups on this characteristic resulted in somewhat negative overall benchmark for the predictability. What we're doing now is, for next few slides, I will be presenting the analysis that we have done for the 2 of the 7 characteristics and looking at the timelines and the cost of delay. So the way we went about doing the analysis for timelines is we looked at the publicly available data for all the major projects in the databases dating to 2015 and later for both Canada and the United States. The project timelines were analyzed for pipeline projects, LNG, and oil and gas wells. The presented timelines over the next few slides are the averages based on CERI's research and do not necessarily reflect any specific project. So looking at the analysis of the timelines for LNG projects, as you see here on your slide, what we're seeing here are that the Canadian pipelines, Canadian LNG projects definitely take longer in the approval timeline than the US LNG projects. US companies are also able to start construction faster after the approval has been given, and few reasons that were identified through our analysis were to do with the seasonality, the availability of resources in Canada, and mobilization of resources. US companies were identified that they could mobilize resources much faster and earlier than the Canadian companies could. In addition to general LNG project approval time being low in the United States compared to Canada, FERC has recently accelerated certain LNG projects. Examples include Driftwood LNG and the associated pipeline, and the Port Arthur LNG and the associated pipeline. They're also working out agreements with Federal Transportation Department to reduce red tape in LNG pipeline approvals. When it comes to major pipelines, again, as you can tell from the graph here, is that the approval takes longer when we're looking at the Canadian examples of pipelines, whether they're interprovincial pipelines versus interstate pipelines in the United States. The FID data was not available for projects that we evaluated in the United States, and hence we do not have the data that's reflective of showing where FID falls within the timeline. When it comes to, however, a typical oil and gas onshore, typical oil and gas wells, the timelines are quite comparable and similar between United States, federal and state oil and gas wells and Canadian provincial approval timelines. The box there on the bottom you see is a summary of all three charts that I have shown you. As I mentioned, for pipeline and LNG project approvals, there's a significant difference between the regulatory approvals periods of United States and Canada. However, for oil and gas approval, the timelines are quite comparable between the two countries. So then next we wanted to analyze in terms of the monetary value, what is the cost of delay cost to project proponents as well as the public? And this is something that is not talked very often about. We're always sort of concerned about what the cost would be to the project proponent. However, there is an associated cost that is directly to the public and Canadians. Basically, what we have done is we used a discounted cash flow model to evaluate the supply costs of various projects in the United States and Canada. And what we're doing is we are estimating relative effective tax rates for each case study and comparing those. We then excuse me, we then lay 1 year delay into our projects after FID, which causes an increase, a direct increase in capital expenditure, which is incorporated into the model. And then the way we presented the results, we show the tax loss as an estimate or a direction of a direct cost to the public, whereas the profit loss is estimated as an indication of direct cost to the company. All right, what you see here are the supply cost comparison between the states of Texas, North Dakota, and Pennsylvania, and BC, Saskatchewan, and Alberta for an onshore oil well. As you can see, prior to 1 year delay, the supply costs of BC, Saskatchewan, and Alberta are quite comparable with the numbers that we see in Pennsylvania and Texas. Whereas North Dakota is quite much higher than the other two states. But when we bring in the delay in the provinces of BC and Saskatchewan and somewhat in Alberta as well, those costs become quite comparable. Basically, what this is to say is a delay has a significant cost associated with that. So when we look at the breakdown of the tax and profit losses, here on top chart you see are the breakdown of different taxes and royalties and carbon tax in cases of Canadian provinces. And as you can tell that the provinces, the oil wells in the provinces of BC, Saskatchewan, and Alberta are quite competitive against the Texas and North Dakota. However, when we bring in the delay, what you see on the bottom there is the delay would cause it at about 5 to 10% increase in losses when it comes to taxes and profits for the project proponent. When we compare the onshore gas well in the same jurisdictions as we have done for the oil well, the cost of delay in British Columbia, Saskatchewan, and Alberta make those wells uneconomic as they compare to North Dakota and Pennsylvania, and somewhat economic with the state of Texas. The one disadvantage for the supply cost in states of Texas and North Dakota is a severance tax, which is not applicable in the cases of Canadian wells. However, the addition of carbon tax is an additional cost item for the project proponents in the provinces of British Columbia, Saskatchewan, and Alberta. When we when we look at the cost of delay, again, similar structure of evaluation. We first look at the tax base, and as you can tell, with the addition of carbon tax in BC, Saskatchewan, Alberta, the percentage of the tax as a percentage of revenue is significantly higher than for North Dakota and Pennsylvania, but is still competitive with the state of Texas. When it comes to the tax and profit losses, a 1-year delay would cause about anywhere from 5 to 10% of loss in millions of dollars in 2019 Canadian dollars for Canadian public and the private sector. Looking at, looking at the case of a interprovincial crude oil pipeline, what we've done here is we assessed a hypothetical pipeline between New Mexico and Texas and Alberta and BC. And then we laid a 1-year delay onto the case study for Alberta BC pipeline. And as you can tell, prior to the delay, the pipeline in Canadian jurisdiction would have been more competitive than that in the US jurisdiction in Gulf of Mexico. But with 1-year delay, we see a jump in the cost, especially on the capital cost, and hence makes the pipeline uneconomic in Alberta BC jurisdiction than it does in New Mexico, Texas. Again, looking at the tax and profit losses, when it comes to the discounted profit loss, we're going to see a loss of about $259 million or 10%. From the original value. And when it comes to discounted tax losses for general public, we're going to see about $117 million of loss in tax revenues, or equivalent to about 10%. For the natural gas pipeline, we are seeing similar results given the, it's a similar tax structure for both cases here. Again, with a delay in the delay of the construction of the project, it makes the pipeline, the gas pipeline in Alberta BC case, less economic than it does in the United States. For LNG, we've done a hypothetical assessment again. We looked at a LNG facility in British Columbia versus that in Texas. Already, even without the delay, the supply costs for jurisdiction of British Columbia, the costs are slightly higher than they are in Texas. And with the addition of 1-year delay, it brings the cost a little bit higher than, even more higher than Texas. We're looking at about $1 per MBTU or MCF difference. The 1-year delay will result in 8% in loss of tax revenues, or $295 million. Or 6.4% loss in discounted profits that were unrealized as a result of the delay. Looking at the gravity-based structure, so this is an offshore crude platform. The supply cost of a hypothetical Newfoundland gravity-based structure is already higher without even the 1-year delay than it is in Gulf of Mexico, which is not surprising. Adding additional 1-year delay will bring the supply costs even higher. We are looking at about 15% loss in the discounted profits of about $1.6 billion over the project life, and about 40 million loss in discounted tax revenues. So this is just a summary of the cost of delay that I presented to you as a percentage expressed as a percentage of initial CapEx. The blue line the blue bars represent the results that we have analyzed and estimated through our modeling, and the orange bars represent the results of our survey. As you can see, there's quite a large discrepancy when it comes to large industrial facilities like LNG or linear pipeline projects like natural gas or crude oil pipeline. However, when it comes to oil and gas wells, the estimated results and the survey results are quite similar. Again, bringing all the jurisdictions together into one slide and expressing the cost of delay in dollars per MBTU or as a percent of revenue for tax and profit loss. There's an interesting pattern that is developing here, where the cost of delay is quite significant for the traditional oil and gas wells, as you can see by the bottom chart there. However, what we've noticed from the survey results, that those are the least impacted or least likely to be delayed, whereas the large industrial projects will carry delay in those large industrial projects will also carry significant loss. However, they are most likely to be impacted, or most likely to be delayed in the approval timeline. When we did a risk assessment on various uncertainties through the CAMP model, these are the factors that are identified in terms of high and low risk, and you see the legend there on your screen. Market factors and project economics and regulatory approvals were the highest ranked hurdles that have associated high risk assigned to them, whereas project financing or carbon management policies carry the lowest risk. This is the summary sheet. However, when we look at this risk assessment on case-by-case basis, you can see there's some changes that have happened in terms of the reevaluation of these uncertainties, where for pipelines, regulatory approvals are now number one, or the highest item, highest risk hurdle that's being assessed for the pipelines, whereas for LNG and oil and gas wells, those are the market factors. Some of the regulations that deal with the economics or environmental assessment of the projects also have shifted depending on what case study you're evaluating. So in conclusion, what we have identified are that regulatory uncertainty and market access were ranked as the top hurdles that impact Canadian business success within the oil and gas sector. The regulatory cost competitiveness was of concern for offshore wells as well, and for pipelines, and of lower concern for onshore wells and LNG facilities. Survey responses show somewhat different perception of the stakeholder groups in Canada regarding the 5 regulatory characteristics that we have analyzed, with the largest discrepancy being on predictability of the regulatory framework. When compared between Canadian jurisdictions and the 4 cases that we have studied, compliance and regulatory improvements received the highest rankings, whereas stringency and transparency were the other characteristics most respondents agreed on. The predictability was one that has caused the largest disagreement among Canadian respondents in the survey that we have sent out for all 4 cases, and have received the lowest ranking. When we compare the regulations between the United States and Canada, we didn't see a large distinct advantage to either economies when it came to onshore oil and gas wells. However, we did see larger timelines for Canadian projects within LNG and pipeline spaces than we do in the states of Texas, North Dakota, and Pennsylvania in the United States. The delay in the Canadian regulatory approvals they do give a significant economic advantage to US jurisdictions, as you just saw on the slides that we compared the tax and profit losses. And the survey respondents categorized market factors as the highest risk category for Canadian investments. However, for pipeline and LNG project approvals, there's a considerable difference between the regulatory approval periods of the United States and Canada. And for the US and gas wells approvals, the timelines, as I mentioned, are quite comparable between US and Canada. Also, in the conclusion, what I would like to say is that going through and evaluating this very complex regulatory space is we understood that it's not quite simple to just say that the Canadian oil and gas regulatory framework is not competitive. What we found is that it depends on case-by-case basis, and we do really have to understand what the case is and what jurisdiction that we are trying to evaluate. So thank you very much for your time. We do have time for questions, so please feel free. Oh, we do have one question here. Let me just open this up. So question was, when looking at regulatory approval timelines, what projects are considered outliers? Really good question. So let me just grab the list of so in the report itself, you will see the list of the different pipeline and LNG projects that we have identified. So the outliers, so of all the pipelines that we evaluated, the outliers were Northern Gateway, which has taken, since now the project has been canceled, but it is in our study period. So Northern Gateway took 79 months for approval. So that was an outlier, as well as the Trans Mountain expansion project too, at 55 months is an outlier. Were there any other questions? Oh, okay. Could you reiterate when the full report will become available? Thank you. Another really good question. So we are in the process of doing sort of, last read of it and last leg of it of formatting. I'm hoping the report will be published by the first week of March. So I can't give you the exact timeline. I'm sorry. You have mentioned, so next question, you have mentioned that you had low responses to your survey. How did you connect with Indigenous peoples for their perspectives? Direct contact. We have a large network of a few different organizations, as well as individuals who are involved in the Canadian oil and gas space. It was through direct contact or through direct contacts that have forwarded us other contacts that we should contact. Unfortunately, as I said, we were only able to get Indigenous perspective from within Canadian jurisdiction. We were not successful at getting contact with the Indigenous population in the United States. Okay, well, if there aren't any more questions, you guys have saving you 20 extra minutes of your morning. Again, thank you very much for your time and attention. Again, I apologize for the state of my voice. The presentation will be available to you immediately. The report itself, with the full details and what we talked about this morning, will be available to you in a few weeks. Thank you very much, and we will see you again.